All right, so this is our last session for this class. We're a little bit ahead on the class, which is okay. Give us some time to maybe look for some topics for paper 2 to discuss in a future class. I did do some research on the Scott Wilson from LA Times and typed, I Googled his name, Scott Wilson, and LA Times and title insurance. And there are some interesting articles. Uh, the title insurers are very touchy about this topic, but it is a very concentrated industry. A few players represent over 90% of the market. The title insurers argue that they're doing a lot of work that's necessary, although it appears that automation and digitization, sorry, I can't say that word, are reducing a lot of their workload. And so, it's interesting. It's not an industry I know that well because the insurance industry is not allowed to sell it, but it would make, I think, a very fascinating topic. Um, if you know someone in that business, you might talk to them about it. They may be touchy about it though, so be cautious. So let's move on to a new topic, property and casualty insurance. So a premium, an insurance premium, is nothing more than a discounted cash flow. So we're going to use the term pure premium. We talked about the pure premium when we were doing the credit score use. Property casualty side uses the pure premium idea. Pure premium is simply the premium that covers the claims. It's the present value of future claims. It does not include expenses, doesn't include profit. It's simply how much do we need to charge in premiums to exactly cover the claims. That's why pure premium was used in the credit scoring article, because they just wanted to see how much more expensive people with low credit scores were than people with high credit scores without getting expense loading and profit and all that mixed into it. The life insurance industry doesn't use the word pure premium. They use the term net premium. Any that have taken my life insurance class know that this is a big part of the class. A lot of formulas, pretty straightforward. To me, it's much more logical than the property and casualty side. When I show you the formula for the P&C side, I set it up as a finance person. If you're an actuarial major, it looks very different in actuarial exams, whereas what I do on the life insurance side, the formulas I use are actually the actuarial formulas. On the property casualty side, I just cannot use the actuarial formulas. They just don't make sense to me as a finance person. So I'll just warn you, if you're an actuary major, the formula I'm using is right. It works. When I was at UTSA, I was teaching a class on property and casualty insurance pricing, and I got the exact same answer as the actuary, but she said all my formulas are wrong. But when I used her formulas and used my formulas, got the exact same answer. So it just made more logical sense. So I'm going to do this more set up as a finance person, but I will talk about the actuarial side, and you'll see the actuarial side and how it comes out in the math. It's just a different way of doing the math. But it is a discounted cash flow. What is the discount rate? Well, the discount rate for the premium should be the expected return on the investment. Why? Well, getting back to Warren Buffett, we're talking about float, and it's a time value of money issue. So Warren Buffett's saying, hey, I could invest this money here at 5%, or I can invest in Geico at 5% or whatever. So it's a cost of capital, but it's not the full cost of capital. It's just the investment side, how much we can make on the investments. It's an opportunity cost. So what premium do we need today, a pure premium, in order to cover us for those claims? We'll talk. Well, let me put it in here. The gross premium equals the pure premium plus the present value of expenses plus return on capital. That's profit. So that's the entire premium. The premium that they charge you is the pure premium, what they need just to cover losses. Expenses, this includes, remember, LAE and underwriting expenses. So LAE are those expenses for adjusting the losses, the loss adjustment expenses. And underwriting expenses are all those other expenses like accounting, actuary, policy service, those type of things. So we are not going to calculate the gross premium, but all we do with the gross premium is we just add the present value of expected expenses, a capital return on top of that, and so we've got the gross premium. We'll talk a little bit more about this. That was a big part of my job at USAA, was to come up with the return on capital requirement for USAA. Now, when you pay the claims in the future, so we are talking about a present value, the present value claims, the industry is generally thought of as short tail lines and long tail lines. So our short tail line would be like auto physical damage. When we get into Schedule P a little bit later in a few weeks here, or maybe just a few classes here, we get into Schedule P, you'll definitely be able to tell the difference between short tail lines and long tail lines. So auto physical damage, it's not going to take you 2, 3, 4 years to pay that claim. It's usually going to be paid within 6 months, if not within just a few weeks. So, the average duration on auto insurance, and this is including bodily injury, not just the damage to the car, but even the damage to the rider. So it's including medical care and other things. The typical average life is about a year to a year and a half. It's a very short product. And then you have long tail lines. We talked about asbestos and general liability. These are long tail lines where you may insure someone today, but they may not get cancer for 50 years. And so you've got to keep that in place, and you've got to guess who is going to get cancer in the future based on the product, the coverage we're providing today. So that's what we talked about earlier, the incurred but not reported. That can be out 10, 20, 30, 40, 50 years into the future. So, all right, so here's the loading and the profit. We're going to talk a little bit more about that. I don't know why I put it here. I'm going to move this down here. The P&C side, I don't think uses the term gross premium. That's more of a life insurance thing, but it's the same concept. All right. So we're really getting into this float and cost of loads. So remember, there's a delay between when we get the premium and when we pay it out. And we want to account for the fact that delay, because we have the premium today, we can invest it in an investment portfolio. Again, that's why we're using the investment return, expected investment return, as our discount rate. We're going to invest it, and while we're waiting to pay out our claims, we will get float. We'll make earnings on our float. And remember, float is the insurance reserves. We'll look at those a little bit later when we look at the accounting statements. The insurance reserves. And so insurance reserves is essentially those premiums we've collected, and we expect to pay them out in claims. So the fact that they're reserves mean we still have the cash. We have not paid out the cash yet. And so because of that, we get to invest it. We make float. We make earnings on the float. The float is the reserves. The earnings on the float is the investment income. So when we get to the actual formula, this is going to be very, very important to our calculations. What's unique about insurance is we don't know our cost of goods sold when we sell the product. So we sell an auto insurance product today, and we don't know what accident someone's going to have, what the claims are going to be. And so because of that, we have to have some conservativeness in there. We have to have a little bit of margin for safety, just to make sure we're not going to go out of business at the very, very end. So we don't know our cost of goods sold in advance. Most businesses know what their cost of goods sold is before the customer walks out with the product. But in this case, the customer buys the insurance, they have coverage, they have the product, they're fully insured for 9 months, 12 months, whatever. But the insurance company has no idea how much they're going to be paying out. I mean, they have an idea, obviously they have some statistics, but they don't know with precision how much they'll pay out, especially if we're talking homeowners where you have a catastrophe. You could be, first of all, when you sell the product, you don't know what catastrophes are going to hit that year. And then you don't know how long it's going to take you to pay, because if you get a hurricane like Katrina, you can't get your adjusters in there to even look at the property for months. You're banned from going in, and a lot of times that's the case, is you're not allowed to go back into that space until the authorities let you. So it can be months before you pay out a claim on homeowners, because especially if it's a catastrophe related. And then even just the normal claims, a house burns down, it's going to take you several months to rebuild that house, and so it's going to take you quite a while to pay that claim out. And then asbestos is a very, very long time till. And so you have the combination of you don't know how large the claim will be, you don't know when it's going to hit, and then you have the inflation aspect of it as time passes. So auto physical damage is by far the safest. We'll see that when we look at the numbers. You'll be amazed at the loss ratios for Geico versus the loss ratio for a homeowner insurer. Geico, since they only do auto insurance, their loss ratios are extremely. And actually, I can't show you Geico. I'm going to show you Progressive. Geico is part of. Well, I might. Well, we'll see. I can't remember what Bloomberg had on Geico, but I can show you Progressive. Very, very stable combined ratios. Very stable loss ratios. Very predictive business. Homeowners, not so much. Homeowners can be incredibly profitable for 3 or 4 years with huge losses. And then asbestos has just been a huge losing business the last several years. All right, so the return on capital, the profit part, is a return on equity. Now we learned with CAPM that the required return on equity should only reflect the systematic risk of the company. But is that true? Do insurance companies only price their products for the systematic risk that they offer, or do they price it for their total risk? Because you could argue that earthquakes and floods are unsystematic risk. Does that mean insurance companies don't need a return on the capital for the risk that they have for that capital being eaten up by catastrophes? So I think most firms actually don't use CAPM when they look at the return on capital in the pure sense. I think most insurance companies have a higher capital requirement for homeowners than they do for auto, even if you want to argue that homeowners' higher risk is entirely an unsystematic risk. But that's a theoretical question. I've actually never have heard actuaries have that discussion, even though actuaries know CAPM very, very well. I have not heard that discussion, but it'd be interesting to see if there are some companies on the insurance side that actually consider systematic versus unsystematic risk. So we have return on equity. When we have return on equity, equity is another term, especially in the insurance world, is also referred to as capital, return on capital, return on invested capital, with one big exception. For most firms, capital is both debt and equity. So outside of financial services, capital is both debt and equity. Usually for banks and insurance companies, capital is only equity. It's only net worth. And a big part of that is that insurance companies don't usually use debt. Banks certainly do, but insurance companies don't usually use debt. But banks and insurance companies, the bulk of their liabilities is usually customer base. It's insurance reserves, it's deposits, and so it's a little bit different answer. They do have costs to that, and banks do pay rates on certificates of deposits and banking and checking accounts and savings accounts, but they don't usually think of it when they do return on capital. They don't think of that as part of their capital base. They really do focus in on the equity of the firm. Now, hopefully you've seen Miller Modigliani before in your career. If not, if you've never seen it, even if you're an actuary major, look it up. It's a simple concept. It's not that difficult. And it's just simply asking, what is the optimal capital structure a firm should have? So essentially we're asking the question, how much debt versus equity a firm should have? Is there an optimal mix? And I do want to review this real quickly. It applies to insurance companies and banks the same way it applies to other companies. But I do want to make sure you've seen this before. Let me show you Miller Modigliani. And Modigliani, well, there it is right there, Miller Modigliani theorem. When you bring this up, you'll see these graphs come up. Pretty typical graphs. My favorite graph is this one right here. So if you don't understand this concept, if you're a finance major, you definitely have to go back and research this again. Every finance major knows this backwards and forwards. It's an extremely important concept. If you're an actuary, you probably need to know this. I've worked with life and P&C actuaries, and I've been amazed at how knowledgeable they are of these financial theories. I think they're on the exam, first of all, but I also think they know it because it is part of their pricing equation. So what I'll do is, we're getting a little long on this video, so what I'm going to do is I'm going to keep this graph. I'm going to actually put it in my notes, so when we come back in we can talk about it. And what I recommend you do is do a quick look. What I'd recommend you do, Miller-Modigliani, and do Wikipedia. If I can spell Wikipedia, and find the Wikipedia discussion. Read through it. It's not that difficult. If you find it's a little too technical, then start with the Investopedia discussion. Make sure you understand this, and we'll see this. I want to talk a little bit about how it applies to insurance companies specifically. It's not in the class notes. I want to do it off the cuff, mainly because I just want to make sure everybody has had this before. All right, so we'll stop it there, and then next class we will actually get into Miller-Modigliani.